Welcome, friends. Today, we are going to discuss one more tax planning aspect. This is tax planning by using Section 115 BAA of Income Tax Act 1961. Uh, First of all, let me tell you, this entire discussion will be based on my understanding about the provision which is contained in Section 115 BAA. I have also referred to Rule 21 AE of Income Tax Rule 1962. And I have also referred to the circular number 29 by 2019, which is issued by CBDT. So on the basis of my understanding of all these things, I'll be discussing, I'll trying to help you to do some kind of tax planning by using this particular section. In case any further clarification is required, you may directly refer to all these provisions and the appropriate circular. I repeat, circular number 29 by 2019, Rule 21 AE, and Section 115 BAA of Income Tax Act 1961. Let me share my screen now. Yes, friends, this is a very important provision and very useful also. Useful in the sense it will help you directly to reduce your tax burden with by a substantial amount. If you look at the screen now, uh, yeah, first let me start from here. So Section 115 BAA. This is, first of all, let us understand that this is an optional provision. If an eligible assessee is interested, he may exercise this option. And who can exercise this option? It has to be a domestic company. Only this particular scheme or particular provisions are applicable to domestic company, meaning it is not applicable to foreign companies, not applicable to any other assessees like farm, individual, AOP, BOI. To all these people, this is not applicable. And at the very beginning, one has to appreciate one more thing. Once someone is exercising this option, this cannot be withdrawn. That means year after year, you have to continue with this particular provision. And this provision is applicable from assessment year 2020-21 onwards. This means from the financial year 2019-20, one can use the provisions. How to exercise this option? One particular form is there that is called Form 10IC. Online, this form can be uploaded, and this has to be uploaded before due date of filing of return. Suppose for a domestic company, due date of filing of return is normally September 30th. By September 30th, this Form 10IC needs to be uploaded in Income Tax Department's portal. This particular thing, how this has to be done, it is mentioned in Rule 21 AE. You may refer to that particular rule also. Now, you might be thinking that why at all I'll be exercising the option? What is the benefits? First, let us talk about what are the pros. Then we'll go to what are the cons. There are many advantages. The chief advantages that you can see, which is visible on your screen also, that tax rate or the applicable tax rate is 22%. Many of you might be aware of that for a domestic company, the income tax rate may be 25%, maybe 30%. It depends upon their past turnover. But once someone is opting this particular provision, 115 BAA, the tax rate becomes 22%. Of course, one has to pay surcharge and health and education cess. Surcharge is 10% on the tax amount. And similarly, health and education cess is also 4%. And the effective tax rate will become 25.168. 25.168%. So one will be paying tax at this rate. So this is a substantial saving. Let us say from 30% to 22%, or 25% to 22%, either 3% or 8% saving, straight away minimum that saving one can visualize. And in addition to that, there is one more advantage. Advantage is that MAT will not be applicable. Many times, those who are in business or those who are in practice, they know that there are many situations when even if actual tax liability is not there, because of MAT provision, a minimum alternate tax has to be paid. In case of normally a domestic company, it is 15% plus as usual, surcharge and education cess wherever applicable. So even if there is tax liability is not there, one needs to pay a tax on its book profit. That affects the company's cash outflow. And that cash outflow can be protected because MAT will not be applicable. You need not pay minimum alternate tax. You have to pay tax only at 25.168% if surcharge is applicable. At the rate of 20%, 22%, you can understand you have to pay tax. So this is the chief advantage. Now let us come to the cons. What are the problems if you're exercising the option? First, you are already aware of that once you've exercised this option, it cannot be withdrawn. Now, first disadvantage is that you will not be able to utilize your MAT credit. This means if already you are having some MAT credit, you have to lose it. So ideally, our advice will be if already you are having some MAT credit, then first exhaust it, then you can come to the scheme. That possibility is also there. I'll be showing you the relevant circular also. Here it says there is no time limit for opting this particular provision, opting 115 BAA. Okay, since there is no time limit, you can opt this provision at any time. So let the MAT be exhausted fast, then you can exercise this option. So that one can plan. And there is one more, there are a few other disadvantages. That is Chapter 6A deductions, which are applicable in specific situation. For example, Section 80J and 80JJA, 80JJA talks certain deduction if a particular entity is giving employment to new employees. So that deduction one cannot claim. And 80LA, this is one more section under Chapter 6A, which gives some kind of deduction. If the unit is like located in an International Financial Service Center, IFSC, so that deduction, if it is applicable, one has to lose that thing. And then deduction in respect of intercorporate dividends, 80AM, there is one more section. So if someone is getting deduction, some domestic company getting deduction under this provision, here it has to lose that thing. So these are the 80 Chapter 6A benefits one has to lose. That is one thing. And there are few more things I can show you. You can see on the screen, there is a list of 9 items now. Okay, 9 items. If you take Chapter 6A deduction, this is a 10th item. So this 9 type of deductions one cannot get if the company is opting 115 BAA. First is deduction under Section 10AA. This is a deduction which is given to new establishments which is located in special economic zones, SEZs. So that deduction one has to lose. Then deduction which is provided under Section 32(1)(2)A, that is called as additional depreciation. Normal depreciation is allowed, but additional depreciation, many of you might be aware, for certain manufacturing industries on their plant and machinery, additional depreciation of 20% is allowed. So that additional depreciation one has to lose. Normal depreciation one can claim. 32AD, this is one more deduction which is linked to investment. One has to lose that thing. Then Section 33AB. So this is applicable to tea industries, coffee industries, rubber industries, where they can open a development fund like tea development account, coffee development account, rubber development account, and claim certain deductions. And these deductions cannot be availed if someone is offering 115 BAA. The next section is 33ABA, site restoration fund, deduction on account of any site restoration fund will not be available. Section 35 deduction, that is deductions for scientific research, that will also not be available. 35AD deductions, that is expenditure on specified businesses. That deduction one has to lose. 35CCC, agricultural extension project. And 35CCD, expenditure on skill development. So these are the series of sections under which some deductions are available to domestic companies. And domestic companies shall be losing all these deductions if they're opting from 115 BAA. But if someone is not availing all these deductions, so this is not applicable to him, or this particular chapter 6 deduction is not available to it, then you can understand, then opting 115 BAA is a very good option. You are not losing anything and you are saving tax, and you're paying tax 22%, and MAT is also not applicable. So this is the summary of the provision. Now, many times one particular issue comes to our mind. Okay, fine, MAT is not allowed. MAT credit one is going to lose. But what about unobserved depreciation and brought forward losses? To explain all these things, the department had issued a circular, that is circular number 29 by 2019. And in that circular, it has been clarified that brought forward losses and unobserved depreciation can be set up. That means, yes, one can set up, but certain conditions are there. The conditions are the brought forward losses should not be attributed to all these reasons. That means it should be attributed to all these 9 points which I mentioned here and this chapter 6 deduction. So because of these deductions, there should not be any brought forward loss. That means if the brought forward loss is on account of additional depreciation, no, it will not be allowed. But brought forward loss is on account of normal depreciation, yes, it is allowed. So that has been clarified from the circular. Just you may have a look at the circular. Circular looks like this. So this also can be downloaded from the department site. Circular number 29 by 2009. So I am taking you to explain some more points under this circular. You can look at here. Point number 511 in the circular, if you refer to here, it talks about that not allowed to claim setup and brought forward losses on account of additional depreciation. Assets will not be allowed to set up of any brought forward losses, provided it is on account of additional depreciation. That means from normal depreciation. If the brought forward losses is on account of normal depreciation, it is allowed. And para 5.1.2 also explains that there is no time limit. So one can also plan accordingly. One may first exhaust the brought forward losses, if any, then opt into this scheme. That is also possible. Right. And para 5.2 also you can see that MAT itself will not be available. So consequently, MAT credit will also not be given. So these two things are allowed. So considering all these things, what I feel that scheme will be very useful, and one can do good tax planning by using this particular function. Thank you, friends.